Imagine you had a time machine and traveled back to March 1999. The world was obsessing over the Y2K bug. Nokia was the king of mobile phones, and a brand new financial product had just launched under a funny-sounding name, the NASDAQ 100 Index Tracking Stock, trading under the ticker QQQ. If you had put a simple $10,000 into that fund on day one and just walked away, what do you think it would be worth today? By early 2026, the $10,000 would have ballooned into an astonishing $170,845, representing a cumulative total return of 1,608%. To put that in perspective, the broader U.S. market, tracked by the Russell 3000, would have turned your $10,000 into a much more modest $100,241. But what exactly is QQQ? Why did it become one of the most talked about ETF? And is it still the right choice for your retirement fund? Let's have a detailed look. It's an ETF that tracks the NASDAQ 100 index, containing 100 of the largest non-financial companies listed on the NASDAQ stock exchange. It was originally created and sponsored by the NASDAQ exchange itself in 1999. Then in 2007, PowerShare took it over, and now it's called Invesco QQQ Trust. To understand QQQ more, we have to look at its underlying, the NASDAQ 100 index. Go back to January 31st, 1985. The National Association of Securities Dealers had a marketing problem. They were trying to transition NASDAQ from a boring, electronic, over-the-counter trading utility into a premium, world-class stock exchange. At the time, the average company on the NASDAQ was tiny, valued at just $580 million. To get Wall Street's attention, they split the market in two indexes, the NASDAQ Financial 100 for banks and insurance companies, and the NASDAQ 100 for everything else. The goal was simple: highlight the massive, non-financial growth engines of the future. While financial stocks ruled the 80s, history played out differently. The NASDAQ 100 became a global symbol of growth in the last 30 years. The NASDAQ 100 index is strictly rules-based and automated. To get included in this index, a company must be exclusively listed on the NASDAQ stock market, be a non-financial company, no banks or insurance firms allowed, maintain a minimum average daily trading volume of 200,000 shares. Historically, the index did its reconstitution, deciding who gets kicked out and who gets added, just once a year in December. But as you're about to see later in the video, that recently changed in a massive way. So how the index is rebalanced. Normally, the index uses a modified capitalization weighting strategy. The bigger the company, the larger its share of the index. However, to prevent a few massive tech giants from completely taking over, the index implements a strict capping mechanism. If the combined weight of the absolute largest stocks, those making up more than 4.5% or 5% individually, gets too high, the index pulls an emergency brake called a special rebalance. This happened on July 24, 2023, when the Magnificent Seven tech stocks had surged to represent 55% of the entire index. The index administrators stepped in and slashed their collective weight down to 43% overnight, redistributing the rest to the other 93 companies. If you think about it, imagine where a company's stock price will go if you know exactly when it is going to be bought in large volume. In May 2026, NASDAQ introduced a controversial rule change that did exactly that. It's called the Fast Entry Pathway, and it recently triggered one of the biggest forced buying frenzies in Wall Street history. Under the old rules, a newly public company had to wait months before it could join the NASDAQ 100. But under the new 2026 rules, if a company goes public and ranks in the top 40 of the index by market cap on its 7th trading day, it gets fast-tracked. That means it is added to the index on its 15th trading day. This is exactly what happened to SpaceX, which went public on June 12th at a valuation of close to $2.0 trillion. Because it's qualified for fast entry, index funds tracking the NASDAQ 100 were forced to buy an estimated $22 billion to $27 billion worth of SpaceX stock for the market open on July 7th, 2026. Where did they get that cash? They had to sell down their shares in the other 99 companies in the index. And where did the price of SpaceX move? It went down to 149.47 from previous close 160.42, a 6.9% drop. Hold on, why the price dropped when we know that those index funds will buy SpaceX in a large volume? Shouldn't the price shoot up to the roof? I'm not going to analyze why price goes up here, but the lesson is that the price of a company is hard to predict. There are many factors at play, and that's why for the majority of investors, as said by Warren Buffett, investing in an index is better than a single stock for long-term growth. Back to QQQ. The growth over the last 2 decades has been nothing short of spectacular, driven by the massive R&D spending of its constituents. NASDAQ 100 companies reinvest an average of 11.8% of their sales into research and development. Compare that to the S&P 500, which averages 9.4%. If you remove the NASDAQ 100 companies from the S&P 500, the remaining companies spend a mere 1.7% on R&D. This aggressive reinvestment in innovation has translated into superior, fundamental growth and incredible returns. NASDAQ 100 grew its revenues at a compound annual rate of 10.0% compared to just 4.5% for the S&P 500. The NASDAQ 100 generated a total return of 2,078%, completely blowing past the S&P 500's return of 780%. QQQ has beaten the S&P 500 in 7 out of the last 10 years as of early 2026. Over rolling 3-year periods since 1999, QQQ has outperformed the S&P 500 3/4 of the time. QQQ's performance looks stunning, but if we go back to 2000, 1 year after QQQ was created, when the dot-com bubble burst, the price dropped 81.1% to its lowest point in October 2002 from its peak in March 2000. If you had invested $100,000 at the peak, your portfolio would have dropped to only $18,900 in just 2.5 years, and it took 16 years to recover to where the peak was in 2000. While those performance numbers look amazing in the last decade, QQQ is not a magic money machine. It comes with structural risks that every investor must understand before diving in. The first risk is concentration risk. Despite having 100 in its name, the fund's top 10 holdings make up 45.28% of the entire fund's weight. If Apple, Microsoft, or Nvidia have a bad year, the entire fund suffers, regardless of how well the other 90 companies are performing. The second risk is sector imbalance. By mandate, QQQ is entirely exposed to non-financial companies, resulting in a heavy tech bias. Technology makes up 68% of the index. Financials are literally 0%. This means QQQ lacks the sector diversification of a traditional broad market portfolio. Lastly, valuation and interest rate risk. Because QQQ is packed with high-growth stocks, its constituents trade on projected future earnings rather than current cash flow yields. When interest rates rise, those future earnings become less valuable today, leading to sharp valuation compressions. This results in a higher systemic beta of 1.22 to 1.28 relative to the broader market. So how does the NASDAQ 100 actually stack up against the classic S&P 500? To understand that, we have to look at 2 main differences: what's inside the funds and how they perform when things get shaky. First, let's look at the sectors. Think of these funds like 2 different baskets. The NASDAQ 100 is basically a tech basket. Nearly 70% of it is pure technology. You won't find any banks or insurance or financial companies in there at all. The S&P 500, on the other hand, is a much more balanced market basket. Technology is only about 30%, and it includes a healthy mix of other stuff, like healthcare, energy, and banks, which makes it feel more like the whole economy. Let's talk about performance. If you look at the last 10 years, the NASDAQ 100 has been the star player, returning over 20% a year compared to about 15% for the S&P 500. But there's a catch. Investing isn't just about the highest return. It's about how much of a roller coaster ride you're signing up for. Volatility. The NASDAQ 100 swings much wider than the S&P 500. It's as 1.22 to 1.28, while the S&P 500 is your base of 1.00. Basically, when the market moves, the NASDAQ 100 moves 1.2 times more. Risk versus reward. Because of those wilder swings, the S&P 500 actually has a better Sharpe ratio, which is a financial term for saying you're getting a smoother, more efficient return for the amount of risk you're taking. The bottom line? If you're looking for high growth potential and don't mind a bumpy ride, the NASDAQ 100 has historically been a better choice. But if you want a steadier, more balanced journey, the S&P 500 is often the more stable choice. Is QQQ the only choice if you want to invest in NASDAQ 100? Of course not. There is a global ecosystem of ETFs designed for different investors. QQQ, it is the default choice if you are in US. Invesco QQQM, launched specifically for long-term retail investors. It charges a lower fee, has a lower annual turnover rate, and historically yields slightly more in dividends. SPDR Portfolio, NASDAQ 100 ETF QNDX. It is the cheapest NASDAQ 100 ETF on the market. Because it is new, it has wider bid-ask spreads, meaning it is best suited for long-term buy and hold investors. For Canadian investors looking to dodge currency conversion fees or hedge USD volatility, BMOZQQ tracks the index but uses forward contracts to hedge the currency risk. BMOZNQ, the unhedged sister fund, letting you experience pure USD-denominated movements. iShares XQQ, strong alternative options for Canadian allocators. Whether the NASDAQ 100 belongs in your portfolio depends on your personal risk tolerance and long-term financial goals. If you seek maximum exposure to the companies defining the future and have the stomach for .com-style volatility, then low-cost options like QQQM or QNDX are your path forward. If you prefer the stability of the traditional market, the S&P 500 remains the benchmark for a reason. In the end, it is not just about the potential return. It's about finding the investment that lets you sleep at night while your wealth works toward your future. Thanks for watching. Please comment below your thoughts on QQQ. See you in the next one.